SpaceX went public at an implied $1.7 trillion valuation. That IPO instantly put a capital-intensive rocket, satellite, and AI operator in the same market cap league as the most profitable companies in history. At those prices, investors were asked to value SpaceX at well over 90 times its 2025 annual revenues, even as its AI division burned $13 billion last year. Anthropic and OpenAI just announced their own IPO plans, both with presumed valuations in excess of $1 trillion, coming to market on the back of enormous compute bills and highly concentrated revenue streams. No real market scrutiny, no hard questions being asked by major investors, no underlying supporting fundamentals, just a massive premium paid for what might turn out to be a functional business model 10 years from now. Despite most of SpaceX revenue being from its own Starlink satellite launches, Anthropic's doublespeak about AI ethics while it continues to book revenue from its deployment and combat operations by the US military, and OpenAI CEO's very public struggle with being truthful. All three companies will successfully raise hundreds of billions of dollars as publicly traded companies. So how do they keep pulling this off? How do these P.T. Barnum three-ring circuses continue to command the attention and capital of investors? The answer may surprise you. It's easy to assume that everyone collectively has lost their minds, or that we are just watching the rich get richer on the backs of retail investors and mutual fund forced buying, but that would be overly simplistic. None of this is random insanity. These valuations are what our market's incentive structure is built around. When I say structure, I mean very literal mechanisms, index rules, compensation formulas, deal structures, and accounting choices that makes a $1.7 trillion SpaceX IPO the new template, one that's bound to be replicated. This really all comes back to the incentive structures that move the market. Before I get deeper into the incentives that encourage this irrational behavior, let's take a minute to look at how we got here. While I'm not sure I can pin an exact time frame where equity markets shifted from fundamentals and business strategy to story time and narratives, we are squarely in the era where a wild and likely fictitious story about a panacea of transformative futures is all that it takes to spike valuations despite pitiful balance sheets and runaway capex. None of the companies I just mentioned will hit the market with a long public track record, stable GAAP earnings, or any real stress tests of their models. They have been fueled with cheap money from patient private investors, patience manufactured by founders spinning grand tales of how big the tech will become and how that will directly translate into the size of their investors' return. What is well established is their PR footprint. Musk, Altman, and Amadei saturate media with endless world-changing narratives. As a result, markets are paying top-of-cycle multiples for stories and charisma rather than substantiated fundamentals. And those business fundamentals tell a very different story. All three companies are massively capital-intensive: rockets, satellites, global data centers, GPU stockpiles, all representing billions of accumulated capex. Yet their valuations are closer to asset-light software or platform businesses than to infrastructure or industrial companies. Investors seem willing to ignore the mountains of capital required to return slivers of profit. You know, one of the best ways to support small YouTube channels like mine is to subscribe. If you like the content and you'd like to see more of it, consider subscribing. Back to the episode. Make no mistake, prior to these companies going public, they benefited from passive investors that had little to no control over their own investment. SpaceX, OpenAI, and Anthropic are founder and insider dominated, with complex governance designed to keep investors and even board members at an arm's length. So even if no one believed these tall tales, they were ultimately along for the ride and hoping like hell some positive version of the story would play out. And these IPOs work because narratives beat numbers. Investors also choose to ignore that much of these firms' revenue is circular. When Tesla puts $2 billion into xAI and xAI then turns around and buys services or assets back from companies in the Tesla orbit at inflated prices, that's not organic revenue growth. That's money traveling in a circle and being counted as sales each time it changes hands. OpenAI gets billions in compute credits from Microsoft. Microsoft turns around and books those same credits as cloud services revenue. Anthropic takes equity investment from Amazon and immediately accelerates its Amazon Web Services spend. None of this is technically illegal. It's structured ambiguity, arrangements that look like revenue creation but function more like a closed loop when you map the actual cash flows. We're about to see how much more irrationality the market possesses. If you designed a test to see whether markets really care about accountability and execution, you'd invent these IPOs. And right now, investors are lining up to take a test they don't appear to have studied for. These are some of the fundamental incentives I mentioned a few minutes ago. Founders are learning that when you hand out nosebleed valuations on incomplete disclosures and unproven models, you can raise billions. Why grind out a decade of boring, transparent cash flow growth when you can sell the dream at near mega cap valuations right now? Then these founders incent their own executive teams to toe the line. Comp packages and stock options at these firms are inevitably tied to stock price and total market cap. A soaring IPO incentivizes more narrative engineering, more aggressive accounting, and more risk-taking to sustain the story. Management starts managing quarter-to-quarter perception rather than decade-long outcomes because the system has told them that's the game. Then there are the venture funds and private investors that only get paid if there's a big exit. SpaceX, Anthropic, OpenAI going public provides those exits. Once those IPOs happen, early investors can sell their shares, take the gains, and move on. If the stock collapses 3 years later, that's not their problem anymore. So they are structurally motivated to support the loftiest valuations the market will tolerate. But why are institutional investors willing to buy these IPOs? Simply put, most of them don't have a choice. Benchmarked funds, ETFs, and index funds can't sit these out. Once SpaceX, OpenAI, and Anthropic are in the index, the structure of the fund effectively forces fund managers to buy. When SpaceX gained near instantaneous inclusion in the NASDAQ 100, something automatic and largely invisible kicked in. Every fund trading that index is now required to hold shares in proportion to that company's weight in the index. The fund manager's personal opinion about the valuation is completely irrelevant. Their job is not to decide whether SpaceX is worth $1.7 trillion. Their job is to make sure their fund doesn't deviate from the thesis. And their literal employment depends on following through with that mandate. So you have a situation where the most price-sensitive buyers in the market, the people managing other people's retirement savings, are structurally and professionally prohibited from saying no. And this is the part that should make every retail investor uncomfortable. When you buy an index fund, which most financial advisors will tell you is the responsible, boring, safe thing to do, you are now a passive participant in funding a potential dumpster fire crammed into that index. You didn't ask to buy shares of SpaceX, and you weren't given a choice. The banks are the last piece of this incentive structure, and they are anything but innocent bystanders. To win a mandate on a deal like SpaceX, Goldman or Morgan Stanley had to walk into a room with Elon Musk and convince him they could place an enormous amount of stock at the highest price the market would bear. Once they've won the business, they go to their institutional clients, the pension funds, the asset managers, the big family offices, and remind them that if they want allocation in the next great deal, they need to show up for this one. The banks control the allocation. They decide who gets shares at the IPO price and who gets shut out. That's enormous leverage, and they wield it like a hammer. Any fund manager who pushes back too hard on valuations finds themselves at the back of the line when the next hot deal materializes. Ultimately, these valuations are not set by a few disciplined buyers, but by a herd of coerced participants. When you peg executive compensation to stock price, tie asset managers to benchmarks, add trillions into passive investment products that are forced to buy the biggest and most overweighted stocks, and then feed the whole thing with an AI turbocharged narrative, you should expect markets to reward risk and poor performance at scale. One benefit of this SpaceX IPO is we now see these incentive structures laid out in plain sight. A rocket and satellite company with huge CapEx needs is treated like a frictionless software platform. Two AI labs with circular revenue and questionable strategies are treated like mature monopolies. Founders and executives are paid to maximize day one valuations, not decade-long durability. Early investors need an exit at the highest possible price. Index-hugging funds and ETFs are punished if they refuse to buy whatever ends up with the largest market cap, and the banks in the middle only get paid if they can shove record-sized deals through that entire pipeline. If you consider the machinery of incentives, these IPOs are not irrational at all. They're exactly what you should expect. That's how we get $1.7 trillion valuations on companies that lost billions the previous year, and a market that shrugs at governance, circular deals, and AI-fueled financial engineering. This showcases the incentives we've hardwired into modern public markets. So when people say the market has lost its mind, they're missing the through line. The market is doing what it was built to do: reward scale and story over scrutiny, front load the rewards to insiders, and outsource the risk to the greater fool, the retail investors. That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.